All right, so as I've noted previously, we don't usually think of traditional IRAs as being part of employee benefits. But it is very important for us to keep this in mind, either for ourselves personally as we're moving on or thinking about retirement savings, any of our clients, whether that be a planner or we're a planner and they're an individual, or we could be helping a firm. So let's get the basic idea for IRAs. So these are often separate from employer plans, meaning that, based on the name, an individual can open up an IRA even if they have a 401k or 403b or 457b. So that means we could, if we feel like that $19,500 a year isn't enough, maybe we're a little bit older and higher income, so we want to save just a touch more, we have one more avenue to pursue. Now the tax advantage can be limited with a combination of those, but we still have another avenue to pursue. Now up to a certain limit, we'll cover that a bit, and just like 401ks, those investment returns are not taxed. You're only taxed upon withdrawal, upon retirement. When would someone want to use this? They still want to shelter some of their compensation in the years that they contribute. So if they think that taxes are lower now than they'll ever be, then maybe they don't want to shelter. Because right now, I'd rather pay taxes now because I think they're lower than they'll ever be. But if taxes are relatively high now, or I'm in a higher margin, then this might be a good idea. Same with the standard 401k. Not necessarily true for Roth, but definitely for a standard tax preferred plan here. We want to defer tax on investments long term. For 55 or 60, I'm not saying it's a bad idea. It could be too little, too late. And then I think I've already covered these can be in addition to an employer offered plan. So what do we get out of this? Same, essentially, as a 401k. So nothing really has changed here, except these are more accessible. You don't have to be employed to get an IRA. That's the difference from the advantages perspective. Now, what we're missing out on, as I mentioned in the last chapter, if you want to do a Roth IRA and you make a penny more than $139,000, you can't do it. Now, granted, that's about the 93rd, percentile. So that's, if you're in the top 7%, you couldn't do that. Okay. But still, there are people there. And as your income comes higher, your retirement needs are higher. And now again, you can do a backdoor Roth and circumnavigate all this. Early withdrawals still have that 10% penalty. And you can establish after 70.5. And you think, well, but with a 401k, am I going to start a new job? At the age of 71? Probably not. But there is still this limitation here. The 401k, it just depends on when you're working, that there are upper limits to. Tax implications are very much the same, except the limit for an IRA and a Roth this year, $6,000. So it's not $19,500 like the 4 series retirement accounts are. $6,000. So there's not as much room for a tax deferral on this one. And there's also less room to save. And this could be very problematic for, let's say, a very successful self-employed individual. So if they're self-employed, easy 6 figures all day long, they could, at best, using an IRA, have $6,000. Even if they start in their early 20s, that probably won't be enough. Even if we include Social Security, probably won't be enough. Okay. So there are some limitations there. Now, another note on this limit, it's either $6,000 or what you earned in that year, whichever is lower. So if you earn no money in that year, you can't put a dime into an IRA. You make $5,000, you can only put $5,000. So you want an extra tax shield when you're not really earning anything. You have no earnings that year. You don't get a tax shield. Dividends, interest, and rent can't be put into these. Now, let's say though, if you have a spouse that's not working, they might not directly earn $6,000, but a spouse or IRA would circumvent that. Yeah. But for the most part, the limit's $6,000 or what you made in that year, whichever's lower. And that's for Roth and standard. All right, we'll go through the same basic plan mechanics that we saw with 401ks, trying to iron out some of the difference between the two. And at the very end, I have a quick little comparison between a standard employer plan and an IRA. Now, with investments and loans, you get a lot more choice, on average, a lot more choice with an IRA. It's your money, it's your individual retirement account. If you don't like your current vendor, or we call them sponsors of the IRA, but if you don't like your current sponsor, you can switch. But you're still limited to once a year. So you'd roll it over to another sponsor, another account. The only real limitations, you can't invest in collectibles, fine art, to be an example. Traditionally, most of these are securities that you're investing in. If you want to put it all in one stock, there aren't many things keeping you from getting close to that. Okay? I don't know if putting all your eggs in one basket is a very good diversification strategy, but there you go. Can't purchase life insurance contracts. Okay, this is to cut down on the medical settlements. And there are no loans in and of, in the name itself, they're not technically loans, so not per se. You cannot take a loan out against this, which you can with some 401k plans. Now, why I say there are no loans per se, you can take funds out, and if you pay them back within 60 days, there's no penalty. You don't have that 10% penalty. So if you want to call a 60-day borrow and then reimbursement a loan, you could look at it like that, but it's not technically a loan. So if you just need money quick and you could pay it back within a couple of months, you have that option. The 401k or any other 4 series retirement account, you have to pay the penalty, unless you can show that it's a hardship. Now, these accounts belong to the participant. There's no employer matching, so there's no vesting. What you put in there and what you gain or lose is yours. And it's just subject to the withdrawal penalties. Now, this point here may not seem like a negative, but I wanted to bring it up. Your book doesn't go into quite as much detail, but if we're thinking about estate planning, this is very important. This would easily roll over to a spouse with no consent needed. If, let's say, you pass away, you have an IRA, you pass away, boom, spouse gets it. 99 times out of 100, that's a good thing. But if your spouse is unable to consent, or if they've already passed away, it creates a bit of a nightmare from a paperwork perspective. So it might be good to have more than one beneficiary. I do. Just in case. Now, you can have employer-sponsored plans. Very rare. I've never worked with an employer, with or for an employer or a client that offer these, but you can see them. There are no non-discrimination clause. We wouldn't really consider this a true qualified plan. That doesn't mean it's bad. We wouldn't really consider it a true qualified plan. It still has the same limits, so when you're looking at this compared to a 401k and you're wanting to keep your employees, this doesn't look as nice. If it's an addition, sure. The question is, for the employee, why couldn't they just go get their own IRA? And there are some simplified employee pensions that are classified as IRAs. But because they're subject to pension rules and regulations, they have to be qualified in this case, and there are non-discrimination requirements. So ERISA comes to play here. So the Employment Retirement Income Savings Act, it comes into play here. So then, quick comparison to other 4 Series accounts. Bummer, lower contribution limit. It is easier though, this isn't listed here, it is easier to get a Roth variant of these accounts. Even if you make over the $139,000, you can just do a backdoor Roth account. Whereas if you're an employer and they don't offer a Roth 4 Series retirement account, oh well, you're not going to get one unless they start offering. So that's one thing that's not listed here. It's worth mentioning. Yeah, there's no matching. Your vendor's not paying you to use them. If you go to Fidelity, open up an IRA, or Vanguard, open up an IRA, they're not going to pay you to do that. They're going to charge you to do that. So there'll be fees. But you have far more choices. Far more to choose from. All right. A little quick take on IRAs. You guys have any questions? No? Okay.